But if you hold one of these 3.6 million residential properties, residential rental properties, past the 30th of June, the
2028?
2027.
27?
Next year, so 11 months from now, you will be required, the ATO is saying that you will be now subject to new capital gains tax calculations. You're no longer allowed to claim the 50% capital gains tax past that date. So you're grandfathered up to 30th of June with the 50% CGT. So if you sell on the 30th of June, no problem. But if you hold it past that date, they want all property investors to get a capital gains tax valuation at that time, right? But they'll be subject to new methods of calculating capital gains tax, which is generally worse off for property investors.
Hello and welcome to the Money Matters podcast. I'm PJ Patterson, the founder and director of Intrepid Wealth. And today I am joined by Tuan of Duo Tax. You're the managing director of Duo Tax. We're going to talk all things depreciation, probably a little bit about what's happening in the budget and of course, well, as I just said, tax depreciation. So welcome to the podcast, Tuan.
Yeah, thanks, PJ. It's been a real pleasure working with yourself and some of the guys there from IFBF, and so real pleasure to be here and support. And let's unravel some of the myths and bust some.
Yeah, let's bust some myths on depreciation. And you said it's a pleasure to be here. We're actually in your office, and we just had a quick tour before we sat down to do this podcast, and the place is absolutely packed to the rafters with your team. Just tell us a little bit about Duo Tax and how you got started in tax depreciation and all that. What's the journey that you've been on?
Yeah, sure, PJ. And of course, Duo Tax started out as a tax depreciation organization that was helping property investors get ahead through negative gearing as a cash flow tool. A lot of changes around that segment, but that's been going on for 11 years now. But on the past 6 years, we've been helping accountants, financial planners, mortgage brokers with these services, but then found this need for valuation reports. So in our organization, we've now got certified property valuers that are CPV certified, and essentially providing the service for capital gains tax valuations, self-managed super fund valuations, annually as needed, but also doing some transfer work when that comes up. And there's a bit of insurance work, but traditionally the organisation's always been a quantity surveying backed, tax depreciation experts, but now property valuers as well.
Okay. Oh, that's a lot. And I have known you, I don't know how many years now, maybe 10 or so, and I've watched the business grow, which is very exciting. And it sounds like it's growing again as you get a new office and then keep adding to the team. So congratulations on so much wonderful growth. Let's get straight into tax depreciation. So a lot of people, when they hear the word tax depreciation or depreciation, they probably immediately switch off because they think, oh, that's some propeller head accounting stuff that we don't really want to know about. But just basically, what is a depreciation schedule?
Yeah, essentially depreciation is the wear and tear on an asset. In this particular case, quantity surveyors are appointed by the tax office to prepare what is called the tax depreciation schedule. And so in Australia, if you wanted to claim wear and tear on your investment property, the ATO asks of you to get it assessed by a quantity surveyor, someone that's suitably qualified, and that is a quantity surveyor, to work out the underlying asset value of your building on that investment property. So then we're looking at the two assets classes, which is capital works, which is your building structure, roof, windows, walls, doors. And then there's the other element, which is your plant and equipment. So your oven, your range hood, your cooktops, generally anything that's motorized or wear and tears faster than the building is considered plant equipment. So then what you have now is plant equipment as well as capital works, and putting them together gives you what is formed as a tax depreciation schedule that you get assessed and by a qualified quantity surveyor. They prepare this report after an inspection is completed, and then, of course, this report can be used for 40 years of depreciation because it's a forecast report. It's a schedule, and it essentially is providing you with 40 years worth of depreciation claims as a tax deduction. And so depreciation is very much that, a cash flow tool that's provided by the tax office to give you further advantages in terms of cash flow, so boosting your cash flow year to year, depending on how much depreciation you're entitled to each financial year.
Fantastic. You anyone listening to this will need to rewind and probably listen to that 2 or 3 times. But in a nutshell, if I'm buying an investment property, and this is probably where it really comes into play, which is property investors, or if they don't have depreciation schedules on their properties, then they may be missing out on some stuff. We'll get into that. But let's just take the example of if I'm buying a brand new, say, off-the-plan property. It's going to have a depreciation schedule. Again, as you said, it's going to be broken down into capital works and plant and equipment. And that's going to give me, as an investor, some advantages in terms of cash flow. So can you walk through maybe a real live example of how that would help me as a property investor to improve my cash flow? Because we do love this negative gearing thing in Australia, and I'm sure we're going to talk about the budget stuff a little bit later. But for now, because those measures haven't passed yet, just walk through an example of how that helps me as an investor.
Yeah, and so essentially, if we use a basic example, if a quantity surveyor was to give a property investor a tax depreciation schedule, and it lasts 40 years for a brand new asset, and the reason why it's 40 years is the ATO provides you with 2.5% as a depreciation rate for a brand new residential building. And that means, for example, let's keep it clean, a $100,000 building, call it a granny flat, you would be claiming somewhere between 2.5%. So you're getting $2,500 as a tax deduction per year. So $2,500 as a tax deduction, meaning if your assessable income for that year, it comes off your personal income, meaning if your personal income is $60,000, well, your taxable income is now only going to be $57,500. So the difference that you pay in tax becomes a refund and essentially gives you that cash flow advantage. And essentially what you want to do is lower your taxable income as much as possible through interest, deductions, property management fees, etc. Well, depreciation is another type of deduction, except the only difference with depreciation is it's a non-cash deduction, meaning that you don't have to expense it in order to claim it. It is essentially on-paper loss. So written on a depreciation schedule or a piece of paper is a quantity surveyor's assessment of how much depreciation, which will be captured as a tax deduction. So then you're not outlaying any cash in order to claim that tax deduction, which is different to your interest repayments or property management fees, strata fees, etc., etc.
I've heard it referred to as phantom cash flow. Is that a term that you've heard before as well?
Yeah, I have heard that term, and definitely it hits it on the head, that one.
Yeah. Well, and so at the end, though, not at the end. So when I sell that investment property, walk us through, because I think this is a misunderstood concept around depreciation, is that it gets added back in the sale of that asset. Can you just walk through an example of that, or explain, first of all, what that is and what that means, and then walk through an example of how that would work?
Yeah, essentially, because personally, it's an accountant piece of advice, but my understanding as a property investor is if you're claiming the tax deduction today, so for example, in 2026, I'm claiming a tax deduction of, say, $10,000. I've purchased the asset, a year ago, and it was worth $1 million. So essentially, because I've claimed $10,000 in 2026, that asset is actually worth $990,000 now, because the depreciation forms the cost base, right? The total cost of that acquisition of buying of that asset. So if you're claiming $10,000, technically your property is worth $10,000 less. Now, let's fast forward to 10 years' time. Right? Assuming the current rules of negative gearing and capital gains discounts, right? And let's put that aside for a sec. But if I'm claiming $10,000 of tax deduction this year for the next 10 years, that means that my cost base will be going from $1 million today, in 10 years' time is worth $900,000. Now, the situation is when in 10 years' time, generally house prices do increase. So if you were to sell your property in 10 years' time for $1 million and did not gain or increase the asset value, you still have made a capital gain of $100,000. So because your cost base is $900,000 in 10 years' time. So then essentially people are saying, why would I claim, because I've got to pay that back, that if you're reducing your cost base and you sell it for $1 million and you're losing $100,000 because you've got to pay $100,000 in capital gain, why would I claim depreciation? Well, in previous rules, what was referred to as the capital gains tax discount for individuals who are investing in property, you would get a 50% capital gains tax discount, meaning that even though you claim $10,000 every year for 10 years, at the end, when you go and pay back or pay that capital gains, you get a 50% discount. So the $100,000 you claim in 10 years, you're paying back $50,000 to the tax office. So it meant that there was a cash flow advantage along the way, because money today is better than money in 10 years. I'm not an economist, but I believe that's
inflation tends to take care of that for us. Yep, yeah. You're absolutely right.
And so essentially claiming that cash flow or that tax deduction upfront is going to be valuable. And then getting a 50% discount at the end makes it even more worthwhile. And so that's the logic when it comes to claiming depreciation and how that affects the impact on the sale of the property.
And that makes a lot of sense. And I never really thought about it too deeply until I met you, actually. And you've presented at a few things I've been at on that subject and have run through that example a few times. It does make a lot of sense. Again, I think a lot of property investors don't realize that they have to add that back, or that they reduce their cost base, which is a good thing to know. But the benefits, at least until the budget announcements recently, which again we'll talk about shortly, have potentially changed that whole thing and dynamic for certain types of property, which again we'll get into. Just before we move on to that, though, I want to talk about getting a depreciation schedule on an existing property. So just because you don't, let's say you don't get one when you buy an existing property for investment, you can get a depreciation schedule done, and there's a good chance that you have some depreciation that's claimable. So let's say I'm a property investor, and again, let's not worry about the current rules set up that may change, but let's say I'm buying an existing property. What's the benefit in getting a depreciation schedule done on?
Yeah, great question. And so when we're going to get really granular here, and existing properties are essentially a little bit trickier, because what's happened in 2017, as you probably remember, I've banged on about so many times into your business, but also in the forum. The government realized that there was an issue, and what they wanted to do was reduce the chance of overclaiming of assets that were secondhand. So if you had a property that was built in the 60s and you've got 10 owners, subsequent owners of the same property, every owner would be able to claim a piece of the plant and equipment time and time again. And so you would reset the cost base of that asset. For example, you've got these blinds in your property, 30 years old, and you're the first owner. Now you claim $1,000 over a set of number of years. The next person comes in, claims another $1,000. Now, by the time there's 10 owners, you would have claimed potentially $10,000 to $20,000 on that piece of curtain, but the underlying value of that asset might have only been $5,000. So you can see the problem here that the ATO wanted to tackle. And so they tackled this by introducing what is the housing integrity measures, and what it meant that you couldn't claim depreciation on secondhand plant equipment. So essentially, if you bought a property today, PJ, and it was lived in by the previous owner, or lived in by yourself, or owned by the previous owner. So the previous owner, you bought it from somebody secondhand. You didn't buy brand new from a developer or a builder. You would not be eligible to claim depreciation on the plant and equipment. Okay, so oven, range hood, carpets, air conditioning, hot water systems, they're no longer eligible, including what's considered secondhand. If you bought it and lived in it yourself, used it, enjoyed the experience of these brand new assets, then rented it out. You know, so I believe people do this to receive the, I think it's the
homeowners grants.
There's grants in place that allow you to do this, and also capital gains tax benefits previously. And so if you did that, you lived in it and rented it out, you'd no longer claim all the plant and equipment. Now, in saying that, if you buy a secondhand property, existing property, and you do renovations to it yourself, and then renovate it, and then rent it out, you certainly are allowed to claim depreciation, because they're considered brand new. Or if you buy some goods from a retailer like Harvey Norman or the Good Guys, you install it ready for use for the tenant, that is eligible for claiming of depreciation. Now, all these rules have changed from 2017. So if anyone who purchases their property after the 9th of May 2017 would be under these rules, that you would not be entitled to claim that depreciation secondhand. But it doesn't impact your capital work deductions. Capital work deductions, referred to as Division 43, is your structural elements inside your building, right? So things like the slab, the frame, the roof, the windows. These make up 80 to 90% of your construction costs, PJ, which means that even though you've lost 10 to 20% of the construction costs in the plant and equipment, range hood, cooktop, plant and equipment, anything that's motorized, you still got 80% of construction costs to claim. Now, the rule to that is they have to be completed, the building has to commence construction after the 17th of September 1987. So that means about generally at the moment, 2026, your building has to be no older than 40 years to claim depreciation on the building. And if the property is older than 1987 and has renovations, those renovations cannot be any older than the 27th of February 1992. That's the cutoff date for renovations and the original structure. So what you'll find is even though your building is secondhand in nature and maybe very old, there's a good chance that it might have a new kitchen, a new bathroom, maybe some built-in wardrobes, a new lick of paint, some new joinery for the kitchen, cabinetry, etc., etc. These are all considered capital work, and what we found is $30,000, $40,000, $50,000 worth of work generally, at the very least on an older property. And for $40,000, you're claiming $1,000 on every $40,000. So you can see that there is some cash flow advantage there, but it's always worthwhile to check. And now, as you know, PJ, with the access to RP data and the like, CoreLogic, there is an insurmountable amount of information available. So it's as simple as talking to a quantity surveyor. They do a check on your actual property, whether it's an apartment or a house or a townhouse, even commercial. You could find the building date, a building age, or through council information, and then we can get an estimate. So it actually costs people nothing in terms of getting a quote or an estimate of how much depreciation they're eligible for, and all quantity surveying or tax depreciation companies will give you an estimate and a very solid estimate, so you know exactly what you're up against before you even commit to purchasing the depreciation schedule.
And just on that, I mean, I actually did that. I bought a commercial property 5 years ago now, I think. And of course, one of the first things I did was I got a depreciation schedule from you guys. And there was depreciation, much to my astonishment and happiness, that we could claim on the tax return every year, which is great.
Yeah, and in saying that, all the rules that I mentioned, the housing integrity measures, was all addressing residential. So commercial properties, greatly enough, on yours including, you would have been able to claim all the plant and equipment. So they've only limited those rules, the changes to second-hand plant and equipment claims of deduction, only to residential. So if you buy a commercial property or even a residential in a company, but if you're an individual buying a commercial property, you're entitled to claim depreciation on all plant and equipment. So we've got commercial, I just did one now in an industrial warehouse, and they had a big crane in there. The crane looked like it was probably at least 40 years old, still functional. And so we claimed a good $25,000 of that asset value over the next 5 years. So not only do you get to claim a good chunk of plant equipment, the effective life of older plant equipment is reduced. So even though the effective life for a crane might be 12 years, we can claim that in 4 or 5 because the effective life has to be assumed to be lesser than that of a brand new asset. So real good advantages when it comes to commercial that that isn't available for residential property investors.
I'm glad I brought that up because I think a lot of times people that buy commercial property don't necessarily think about doing a depreciation schedule, especially if it's something that's been around for a while or it's in an old industrial area or something like that. I'm really glad you went into that because it is an important distinction to make between residential and commercial, but then I didn't even necessarily realize myself until just now that...
Or even a fit out, right? Like PJ, we did like in our office, we did a fit out, and this building was a 2006 building, and because everything was still depreciable under the 1987 and 1992 rules, we did it. We gutted it, and it was only at that point it was 15 years old. So we gutted it and claimed $100,000 in scrap value, for example. And not only do the scrap value, meaning you claim that as an immediate deduction because it's a write-off. You've scrapped it in that financial year, which was 2020. And then what happens is once you reinstate the new fit-out, you can also claim the depreciation on the new fit-out. So really powerful things that you can do in commercial that aren't common in residential. You don't see people gutting houses as often as you do see commercial spaces.
Okay, maybe we'll get to that in a minute. I do want to talk about scrapping as well, because that's something that I did not know. I had never even heard the term scrapping until you mentioned it at a presentation that I attended a few years ago. Just before we get to that, though, let's talk the pre-1987 CGT issue. The audience of this podcast will be, anyone from maybe 25 up to, in their 60s. But why is 1987 such an important date in looking back at property, as an example?
I actually don't quite understand the history of taxation, but I believe it had to do with housing reform, tax reform. Was it the Hawke era? Keating Keating government that put in place negative gearing changes, or did they reinstate it in 1987? I believe they.
I'm not sure if it was reinstated or put in place, but there was a big tax overhaul that definitely took place in 1987. So that's often referred to as the pre-CGT era. Because I don't think we had CGT up until 1987. I think they introduced something.
Yeah, and before that, I think it was a straight line method, was it?
Not sure about that. Not sure about that. I was in high school and
I was just
in the U.S. and not in Australia, so I know even less about that.
I was 1 year old.
Yeah, there you go. 1 year old. So you definitely didn't know. No, that's fair enough. Well, it's definitely one of those things to probably for anyone who is who might have an asset that they might be inheriting, because that's happening now a lot. People are starting to see their grandparents and their mums and dads are passing away, and they might be inheriting a family home or some assets that were purchased pre-1987. So certainly, I know you're not an accountant per se or a registered tax, or are you a registered tax advisor?
Only for quantity surveying. Yep.
So you would definitely want to talk to your accountant about that. They would be all over those rules, but it's certainly something to think about. Well, let's talk about scrapping then, because I love this subject. I think scrapping is such an interesting thing, especially in this era now where people are doing a lot of knockdown rebuild. And I remember at this presentation, you made something, you said something that really stuck with me, which was get a depreciation schedule done, or maybe it's something different, but a schedule done on the house before you knock it down. Go into the reasons for doing that.
So important, PJ. We've seen lots of money left on the table.
We don't want to do that.
Yeah, and you're buying an investment property, right? You've just invested a lot of money into this new asset. You decide to, it needs a makeover, right? As sometimes you do. You go into the property, you decide to remove the bathroom, the kitchen, new flooring, new lick of paint, and you decide to reinstate it with brand new bathroom, kitchen, flooring, paint. And so critically, all these assets, generally today, to do that type of work, you're looking at somewhere between $80,000 to $100,000 minimum. But if you had something that was built in the 90s, because the cutoff for a building, so if the original structure was still depreciable, which means that it was built after 1987, or renovated after 1992. So if the property's got a renovation or an original structure that's still claimable at the time of you demolishing or for the renovation, that value, the residual value, so if the original structure was, say, $50,000 to build it in 1988, and you've claimed, till today, the previous owners have claimed potentially $35,000. Well, if you were to strip that house today, there would be residual value of $5,000. Once you do the demolition internally for that, to do the renovations, you could claim an immediate write-off of $5,000 as scrap value. That's important because that comes off your tax return in that financial year the demolition happened, right? And then of course the depreciation schedule for the extra $100,000 that you've invested into the property to lift it. And of course the whole idea is to improve the rent and whatnot and the reliability of the place. that would also form the new cost base. And then, of course, a depreciation schedule will help you capitalize on claiming that as a tax deduction for the next 40 years, of course.
And I think I remember you talking about this, even if you're doing as an owner-occupier, knocking down and rebuilding and getting a scrapping estimate or whatever. Have I misunderstood that, or would it only be if you're doing this as an investor?
Yes, only as an investor. So if you're doing it as an investor, importantly, if you're doing it for example, if you're doing a scrap or demolition on your partial demolition on a rental or on a home, and you decide to live in it, yes, you can't claim the scrap value because the intent needs to be clear that it is for investments. But of course, it also is subject to the second-hand existing property rules, which means that you can't claim plant and equipment as a scrap value if it's not claimable under Division 40 or 43, meaning after 2017, if you've purchased it and it's an old property, you can only scrap the capital works as a residential property investor, which is majority of the kitchen, bathroom, etc., because they last 40 years generally.
I guess the moral of the story is, before you knock anything down, call you guys and just check on that and see what you maybe should or should not be doing.
And there's plenty of information, in terms of photographic evidence that's available, even after the fact. If you've done it and after the fact, then we can always go do it in retrospect, because information available is so readily accessible that it is possible to do a retrospect scrapping report to get an assessment of how much you could potentially claim. So, and it's worthwhile just asking.
Yeah. I think it's always best to ask the question because, of course, once you've knocked it down, it's too late.
Yeah, that's right.
Sometimes, right?
Yeah. If there is no evidence in place.
Well, that's exactly right. Maybe this is a good opportunity for you to just maybe give us an idea as to what the costs of a QS report might be. First of all, are they tax deductible?
Yeah, that's a great point. And yeah, it's all tax depreciation schedule tax deductible. Of course, if you're a property investor, $550, which we've got exclusive offers for PJ and clients, is tax deductible, including the GST component, PJ. However, I believe if you're a commercial investor and you're registered for GST, the GST is 100% refunded, and then the $500 would be tax deductible. So certainly that figure is tax deductible, and it's also a one-off fee. As I mentioned, it's a forecasted report, which schedules ahead of time how much depreciation you claim for the entire life of the building or the asset while you own it, and you're entitled to claim it up until the date that you dispose of that asset.
And you produce a schedule, which you just hand that to your accountant, basically, and say, here's the schedule that we're going to use for doing our tax return now and into the future until I, as you say, dispose of that asset.
That's correct. Yep. Okay. Yep, that's single schedule.
And you do a lot of business with mortgage brokers, finance brokers, financial planners, accountants. I mean, you've got a team here of, I think we worked out, what was it, about 150? Yeah. Something like that. Yeah. And many of them are doing that work with this community. It's just tell us a little bit about that. Yeah, and you're nationwide too. You cover all of Australia.
Yeah, essentially we've got a panel of contractors, include quantity surveyors, property valuers, that help us sort of access properties across the country. And so as the property investor dynamics has changed in the last 11 years that I've been in the business, it's certainly people are more comfortable investing interstate, and so we've naturally had this knack to facilitate the demands of the investor, and so that's been sort of pinnacle to our business.
Yeah. I think that's amazing that you can do that, and I was quite surprised actually. I think I had you do a valuation for me on a property up in Queensland, and didn't need to visit the site. It was all done RP data probably, and all this data-rich environment that we have now. You can do a lot of these things without really even going out to visit.
Yeah.
When would you actually need to visit the site?
When you have a current day valuation, that's when you need to substantiate to tax office that you are requiring an internal access, meaning that to get the evidence as it is today, how's it stand today. But when you're doing retrospect valuations and going back in time, that's when you need to then saying, okay, well, I need a CGT valuation, capital gains tax valuation for 2023 because I lived in it and then I rented it out, for example, then that would be the circumstance where the ATO would go, okay, you don't need an inspection because the property might have been sold, or today's standard or condition isn't the same as what it was in 2023. And so the ATO understands that, and so a retrospect valuation can cover it, and so a curbside might need to be done in certain circumstances. When it comes to depreciation, if there's not enough evidence to create a tax depreciation schedule, you would need to get access. For example, is there a fit out or is there a renovation that's done? Are there enough photo evidence to substantiate a claim of depreciation? So if there isn't, then that's when the ATO would say this is something that's needed to provide in order to substantiate, because at the end of the day, we can make a claim, and it's a bit of a trust-based system with the tax office, and you can make a claim up until such time that, of course, the ATO questions, you would need to, of course, provide that evidence. And so that's when it comes to tax depreciation and property valuation, a little bit different in terms of mechanics of requirements and depending on timing of things. But in terms of property valuation, a lot tighter, whereas quantity surveying is a little bit not as clearly defined. But of course, we try to use a bit of a good judgment system here to identify when is an inspection required and when isn't. But of course, the access is there should you need it. And does it yield you better value is a question people often ask, is that you can, essentially an inspection can potentially yield you more if there's things we can discover, but essentially if you're getting floor plans, you've got council information, for example, DA lodgement of that property at whichever point in time, that would be enough to give you a good understanding of that value. And going to a property, a site inspection, you won't be able to see behind what the walls and doors, etc. So it's not something that can yield you more unless there's not enough substantive evidence provided through by client.
This is a really good example to delve into a little bit more, because I think what's happening now, particularly with certain types of investors, like say an SMSF or other holding vehicles, and even deceased estates and things like that, or where people are planning on converting their principal place of residence into an investment property, their accountants and other people will say, well, get a valuation as of the day that you're going to effectively change that asset to a different type of use. Yeah. Yes? So I want to go into that a little bit, because I think this is a very critical thing that a lot of people I know out there do not do this. They don't think, I need to go get a property valuation this month because I'm going to move out of my principal place of residence. I'm going to keep it. We've bought another family home. We're going to move into that. We're going to keep this as a rental. I get that question a lot from clients. And so let's go into that. So why is it really important to get that valuation done immediately for that client? Why is that a key thing?
Yeah, definitely. It's not mandated by tax office. It's an option, surely. One of the reasons why I believe a lot of people do get these valuation reports at the time of renting it out or switching it from PPOR, principal place of residence, to investment, is because at that point in time, there is all the information available to give you data on what your property is worth. And as an investor, you would always welcome a higher valuation, right? You want to be as exact and as precise, but as aggressively high, that's fair and reasonable as possible. And that's a conversation and an argument that you can make today or within the next 3 months. But not so much of an argument that you can make when in 10 years' time when you go dispose of that asset. And I think that's the biggest value in getting a current day valuation for a capital gains tax report or assessment at that point in time. And I believe that's the primary reason why they would do that. But of course, it's not mandated, so you're most welcome. And a lot of, I would say 80% of our clients, PJ, or investors out there, get a capital gains tax report, valuation report, only when they dispose. And it's quite common, right? So.
Well, that's a good tip for any mortgage brokers or financial planners. I dare say even accountants watching this or listening to this who might have a client that's discussing that exact scenario where they think, well, I'm going to keep this property that I've lived in, and it's always been my PPOR. It's CGT free right now if I sold it, but I'm going to rent it. And therefore, as of today, I want to know what the value is so that anything moving forward, that's what they would potentially calculate a CGT event on should it be sold. So that's
and
really
it could
good.
be a big price difference, right? If if we're talking about capital gains tax, it has a massive impact at the time of sale, and so every dollar that can be assessed that's favourable to an investor is good for the investor. So why not lock it in when you can?
Yeah. The ATO, you mentioned a moment ago that the ATO, you sort of push it until the ATO asks questions. How many times, or have you come across a situation where the ATO has challenged something that a client of yours has put in, and then how is that dealt with?
And it all comes down to the impact these reports have to the tax office. If you talk about a tax depreciation schedule, PJ, we've done almost a couple of 100,000 reports in the last 11 years, and we've been questioned by the tax office directly once. Okay, and it was for a claim of, I believe, something like $8,500 in a single year. So they don't come too often when it comes to depreciation. They do ask property investors. So if you're a taxpayer and you go lodge a tax return and you've got some claims of depreciation of $50,000 or $80,000 for your commercial property, they do ask the customer to provide evidence and substantiation, in which the client would come to us and say, hey, how did you come up with these numbers? But that's not really an audit per se. It's only once really we've had that issue. So depreciation, I would say I could count on one hand how many times the tax office has asked us those questions. But when it comes to valuation reports, different beast because of the financial impact it has to the tax office. We do find that they do question the integrity of the report and how we come about preparing them. I would say every few months there's one that pops up, and we're doing something like 5,000 or 10,000 a year, I believe at this point. So they come up every couple of months, and so you would say that more often than not, valuation reports, and rightly so, right? The impact it has on someone's tax position and the savings it can have is dramatic. And so you can naturally, I think that tax office has put more of an emphasis on making sure that the reports are credible and compliant.
Now, a credible report obviously is going to be a schedule that is from a qualified, and do you have a license to do this?
So I'm a quantity surveyor myself personally.
Yep.
But the organisation, Duotax Quantity Surveyors, and then there's Duotax Property Valuers. The valuation team, actually now we're going to the mechanics, tax depreciation schedules are signed off by company, endorsed by a quantity surveyor, right, as a registered tax agent. Property valuation for CGT, stamp duty and whatnot are signed off by the individual. And yes, indemnified by a company, but the individual requires sign off. And so that's the difference. And so, of course, in the property valuation team, we have a whole team of valuers, whereas in the quantity surveying team, we've only got a handful of quantity surveyors that audit or make sure the compliance is optimized. And so you can see the difference in the type of deliveries and how that's delivered.
And so it sounds like the ATO doesn't really ask too many questions. Like you'd have to be doing something massively egregious, I would imagine, for them to. And they would have a massive database too, and be able to compare, similar stuff, benchmark things. But that's a really good track record where you've had you can count on one hand the number of times you've had some questions come back. I guess that speaks to the quality of the work you do, which is amazing. But the tax office probably relies on, and I'd love to hear your comment on this next statement, but relies on people not putting in depreciation and not doing those things. And they're not going to tell you should put that in. Like when you put your tax return, they're going to go, hang on, you haven't submitted any depreciation, Mr. Taxpayer. Can you go do that so we can, you can save some more money in your tax? They're not doing that, are they?
Yeah, definitely. It's a negative gearing is a policy. It's not one that's mandated, and it's disadvantage to you if you don't claim it. And certainly, I believe the stats are something like 60% of property investors don't claim depreciation, PJ, because of the assumptions that we've tried to iron out or bust through these conversations in that, oh, my property's too old, oh, there's nothing left to claim, it's I'm not going to hold it for long. But rightly so, you could hold the property for more than 12 months, 12 months and a day, and you would get the 50% CGT discount, correct? If you hold an asset for that long. And so naturally, it's worth it, even for, given that you got the discounts in place. So there are a lot of reasons why people don't claim, and of course, why the ATO isn't hanging out for you to claim it. But it is there for investors to take advantage of, because it's black and white in the legislation.
I was going to ask you if you had a stat. I'm glad you gave one. 60% not claiming tax depreciation. Any idea on the dollar value of that?
Oh, geez. I don't have a dollar value, but I
It'd be in the billions. I would imagine.
Billions with ease.
Wow.
Billions that they're saving.
Wow.
By people not asking questions.
I think, Julian from Loan Options AI,
yes,
making CGT great again.
Yes.
I reckon you need to make depreciation great again.
Yes.
That's what I think you should have your new tagline as, make depreciation great again.
I love that hat, by
Well,
the
there's
way.
billions of dollars being left on the table, which is, unfairly disadvantaging property investors, and it could be a combination of not knowing, it could be laziness, it could be
Advice.
bad advice. It could be that, again, they just think, well, it's an old property, there's not going to be any depreciation. But the reality
15%, PJ, of our investor base do not have advisors. They're self-taught property investors that go online to seek information, and you can imagine how many people out there get a property, don't get advice, do their taxes online or whatever. I mean, some of our staff here have investment properties and still do their taxes by themselves.
But they have depreciation schedules.
They have yes, that's right. But they're missing a few things, I reckon.
Yeah.
Okay. So definitely, it's worthwhile to have the right advice, right advisors.
I couldn't agree more. And I think, and we probably already touched on this, but for the cost of a depreciation schedule, which again, as we've established, is tax deductible, the likelihood of you getting more back because you got that schedule done is much higher than what people might think. So it is probably a rare occurrence where you do a schedule and you go, well, there's nothing for you to claim except for the cost of doing the schedule.
Yeah, and it happens, but it happens early on before the customer even commits, because of the availability of data. We're living in 2026, like information, everybody's property is literally, available online, as scary as that is, but that's the truth. And that makes our job easier, and it helps the property investor get ahead, because we're able to give them an assessment. Hey, it's going to be $2,000. And yeah, if it's $2,000 as a tax deduction isn't much value to you, ask your accountant, hey, Tuan or Tax has said $2,000 in tax deductions. What's that look like in terms of cash flow? And they might say, look, you're on 47 cents to the dollar as a tax rate. And so you're going to get back $900 a year for 10 years. That's $9,000, better in your pocket than the tax office. Would you? And so the advice can come down to that, and it can get as granular as that to make sure we're adding value.
Wow, I love that. That's a few date nights, that kind of coin. All right, we're going to segue into the budget, because the budget is a very topical thing. We've just recently had the federal budget announced by the treasurer. There are some significant changes that have been proposed. They are not law yet, so they have not passed any of the normal legislative processes. At a high level, walk us through, as property investors, et cetera, what are the most significant budget announcements?
Yeah, on my end, in terms of on our end here, what we're dealing with property investors, there's two fronts, and that is the negative gearing changes as well as the capital gains tax. And these are the biggest two topics when it comes to investors that we can tackle. We'll go to negative gearing first. Negative gearing, as mentioned, PJ, is your ability to claim tax deductions when your cash flow position falls below zero. So if you've got rental income, you're now in surplus of X, but then you've got interest deductions. So that brings your cash flow down. And then you've got property management fees, strata levies, water rates. These will bring your cash flow down. Once it goes below zero, you currently are able to claim that negative gear or that negative value as a tax deduction against your personal income. You probably know better than I, by the way, so please
No,
interrupt.
I love your explanation. You keep going.
Okay, and of course, once you're in the negative, what tax depreciation does at the moment is it brings you even further negative because you're losing value on the decline in value of your building. Depreciation, right? That depreciation also comes off your personal income. So further reducing your personal tax, personal income tax, and then of course giving you that refund. So that's what negative gearing is. Now what they're suggesting is abolishing negative gearing for second-hand residential properties. Okay, residential properties.
That's an important distinction, right? It's not commercial, it's residential only.
Yeah, and second-hand in nature. And so that means that once your property goes to zero, you can no longer bring it below zero. So it doesn't matter if you've got property management fees and your water levies, etc., you won't be able to claim below zero, so you won't receive a tax deduction at the personal level anymore when it goes below zero. So if you've got $10,000 in rental income, your interest is $8,000, that means you've got a surplus of $2,000. Now, if you have a $10,000 income in rent, but your interest is $12,000, you can only use $10,000 of interest, meaning you got $2,000 in surplus. Now, of negative, right? So you're $2,000 in the red. Now you add in your water, your strata, your depreciation. Your $2,000 goes to $10,000 negative in the red. Now that $10,000 cannot be claimed anymore at the personal level, but what you have to do is carry those losses forward, okay? And those losses can be quarantined, is the word they're using, up until such point that you can use it. So for example, in year 2, you now incur another $5,000 in red. Now by the time year 3 comes, you now have $15,000. So $10,000 year 1 in red, $5,000 year 2 in red. By the time year 3 comes on, I've got $15,000 in quarantine losses. But if I'm in year 3, if I'm positive after all deductions, I'm positive by $15,000, I could take year 1 and year 2's losses and bring that down to zero. So in year 3, even though I'm 15,000 positive, I'm still using the depreciation and the interest and all those negative losses, quarantine losses from year 1 and 2 to offset year 3's. It doesn't have to be on the gain, meaning when you sell, it can be done as to offset the rental income.
So it can be used against capital or income. Yes. So if you sold the property in year 3, that quarantined carry forward loss would be usable in that. Okay. Interesting that they're doing that. So that quarantining of the loss will just carry forward into perpetuity until you either have a positive income to offset it against or a sale and a capital gain event where you would offset it against.
And it can be a group as well. Yes, that's correct, PJ, but it can also be a group of properties. So they're not limiting it to each asset has to be assessed in its own right. You could group these properties, and if you have 2 negative geared properties and 1 positive geared properties, they could offset each other in that current year and in future years as well.
Well, that's an interesting thing. It does complicate things a bit. My first question was going to be, do they all have to be in the same name? I imagine they would.
I would imagine so. This is the complication that accountants will have to deal with. And they haven't laid out very clearly how this is going to happen because it doesn't come to effect until 1st of July 2027. And you are under these rules as it stands now, if legislated on the, I believe, 2nd July 2026, in a month's 2 weeks' time, they're going to legislate this. But from the 12th of May 2026, if you've purchased a property after that date, you will receive negative gearing still, claim below zero, up until the 30th of June 2027, until which time, once you switch over that date and you hold that property, you will be under the new negative gearing rules. So you can negative gear for only another year, and then you'll no longer be able to do that from FY28, so 1st of July 2027.
So as an observer of this policy, my suspicion is that what they're trying to do is encourage property investors to invest in new stock to increase the overall stock of housing that is available for Australians to purchase. Would that be your view on it as well? That's what they're trying to engineer?
Yeah, I don't want to get into the politics, but as they stipulate is that the idea is to, as they had the housing integrity measure from the last tax reform in 2017, this one is about increasing supply, net supply, meaning that a granny flat, for example, you build on your own property, is not increasing the supply because you cannot subdivide a granny flat in a house. But if you build a duplex on your standalone dwelling, is increasing the supply because you can subdivide a duplex. So that's a very clear definition that they've got when it comes to increasing net supply. And so that means that brand new houses or residential properties are exempt from negative gearing. So they are allowing you to continue claiming negative gearing on brand new properties, as well as self-managed super fund properties and any properties bought in companies, and also commercial properties are exempt, which means that you continue claiming second-hand plant and equipment, and as well as negative gear that asset.
So just to rewind the tape for a second on that. So properties that are bought in a company, existing properties in a company, or SMSF, or a trust, or just companies and SMSF?
I'm not sure what type of trust, maybe certain
discretionary trust.
Yeah.
Like that. I mean, there's a whole bunch of new rules coming in around that. So
yeah,
let's just stick to companies and the SMSF. Well, SMSFs are trusts, right? Yeah. That's why I mentioned any trust. But let's say SMSF. Just repeat what you said a moment ago. So those structures, even if you buy an existing residential property in a company or SMSF, the rules do not apply.
Correct. Company, SMSF, or commercial property can enjoy negative gearing.
Okay. Interesting. So wouldn't everybody just start buying these properties in companies? That's
exactly what is the news anyway at the moment. I personally have done the same. Just exchanged on a property in Perth as a company because I think it's, bearing in mind, it's not because of negative gearing. From this is an opinion, by the way, it's because of the CGT rules that have been brought into place that marries up with the negative gearing abolishment that is encouraging myself anyway, and I'm sure, based on the news, a lot of other investors to look at pivoting towards that.
So the moral of that story is it'll be interesting to see how the behavior of investors is shaped over the next probably 12 to 18 months as we get closer, and especially if this legislation passes in the next few weeks or next month or so, to see what the behavior is, and if we actually see an increase in DA approvals for new builds and all these sorts of things. Like we ought to probably know within 12 months whether the intended behavioral change that the government budget measure is seeking is actually starting to play out.
Have an impact, yeah. Yeah,
that's more of a comment than anything, I suppose, but it'll be interesting to watch.
Short term, I think the impact is that the existing housing market has had a bit of a downturn, and naturally so, right? The fear is there, but how it plays out mid to long term, I think, is yet to be seen. And construction costs are all-time high, as you know, PJ, and I think the economy has felt that in the last 5 years since COVID. And it has no signs of easing, especially with inflation high. And so the intent of the investor to buy brand new isn't very enticing when it costs a lot to build, and you pay a premium for it.
Well, and you will pay a premium for it because, of course, what it'll probably do in the short term is it will drive people towards one thing, drive up the cost of that. And here's the interesting scenario, and I'm glad you brought that up because I want to just play a scenario out. So let's say I buy an off-the-plan property in my own name to continue to take advantage of the negative gearing stuff. And then 5 years later, I sell it. It's now an existing property. And who am I going to sell to? If I was an investor initially, I'm probably not selling to another investor. I'm probably selling to someone who's going to occupy it. So in a way, that's maybe going to change where, as an investor, I might want to buy, because I don't want to just buy something that a bunch of investors are going to be in the same complex, because that could affect the future value of that asset. Have you guys or anyone on your team thought about any of those scenarios like that, buying those off the plans in the brand new, and then what happens, say, 3 to 5 years down the track?
We don't talk about it internally, but my experience is when I've bought brand new, it certainly was, yes, negative gearing benefits, but it had a lot to do with buying in a location that would have strong resale, right? And owner occupied is an important factor, and I think that shouldn't change. But I think you're right. I haven't even thought about the fact is what you've just said there. Investors, the sentiment from the new purchaser in 5 years' time is important. Where are their thoughts at? What are they thinking? And you're right. If it does appreciate, and it should generally in the history of time, if time tells a story, it will appreciate. But if now I'm up for competition because someone down the road or the next suburb over is new development and they get all the negative gearing benefits and I don't, in terms of transferring my property to the next person, that's going to cap me because I've now been sort of segregated from that. And so in my time, I've never experienced this. So it's new to a lot of people. So it'll be very interesting to see how this plays now. It's the first time I've heard it, PJ, and it's very interesting.
Well, I was just thinking about this as you were talking, and another unintended consequence is potentially that it decreases the amount of stock out there, because that person who bought it as a brand new property doesn't sell it and doesn't add it back into the normal turnover of stock, because they know that they're going to have to take a hit when they sell it, because the next person, especially if they're an investor, is going to want to offset the fact that they don't get any negative gearing. I mean, these are unintended consequences that I dare say government doesn't seem to really think through. Now, maybe they have in some back room or backdoor backroom environment, but it just seems like, we're just sitting here doing a podcast and we're thinking about some basic stuff around this and going, I wonder if they thought of that. It's very interesting. And I do know, by the way, that investment lending has dropped in the last month since that budget announcement by about 20%. So investment lending to investors is down, and I think investors are trying to work out, what the next move is and what they should be doing. Yeah, exactly, how to pivot. Something I wanted to quickly touch on, which I meant to earlier, was this increase in people buying property to Airbnb them, and whether there's anything interesting around that you've observed in doing either tax depreciation schedules or valuations or anything, where the property is the intended purpose of it is for Airbnb or one of the short-term rentals. Any comment or anything on that?
We don't have too much information around when the property is Airbnb, so I can't give you too much intel. But I do know that Airbnb are being treated when we do these short stay rentals. They are assessed like standard residential investment properties. So you won't get negative gearing on them moving forward. You're under the same legislation when it comes to second-hand plant equipment, in which you cannot claim. If it's a residential property, which all Airbnbs are. So the same rules apply, unfortunately, for Airbnb. But of course, when it comes to the mechanics of cash flow, that's something I can't really comment on. I don't have any myself either.
Well, if you believe all the Facebook ads of these people doing it, they're making squillions of dollars doing it. And of course, we know that some councils around the country, especially where there's a high amount of unit stuff like Gold Coast or Sunny Coast, or maybe even Brisbane for that matter, they've tried to restrict some of that short-term rental stuff in buildings because it takes away from the housing stock for normal people that want to have a long-term rental. So it's very interesting. I think that particular issue has been around for a little while, and it's kind of subsided a little bit in the last few years. You don't hear too much more about it, but it's interesting.
It is.
Any final comments or subjects that you'd like to touch on? Maybe anything that you're dying to get off your chest about depreciation and valuations?
I'll tell you the one that's really bugging everybody is CGT valuations. The change in the landscape for capital gains tax is, I think, bigger than the negative gearing news, to be honest. Yeah, it's hitting the property investor the negative gearing news, because it means that the landscape in terms of which you can lend or your borrowing capacity is impacted. Is that right, PJ?
It is, yes.
So that's important. But what's really critical, I think, is more impactful that affects 3.6 million property investors, and this is just residential. So there's 3.6 million residential properties available in the market that are currently rented out or available for rent. These will all be subject to the CGT changes. Now, the capital gains tax changes doesn't grandfather. It does to a certain degree up until the 30th of June. But if you hold one of these 3.6 million residential properties, residential rental properties, past the 30th of June, the
2028?
To 2027.
27.
Next year, so 11 months from now, you will be required, the ATO is saying that you will be now subject to new capital gains tax calculations. You're no longer allowed to claim the 50% capital gains tax past that date. So you're grandfathered up to 30th of June with a 50% CGT. So if you sell it on the 30th of June, no problem. But if you hold it past that date, they want all property investors to get a capital gains tax valuation at that time, right? But they'll be subject to new methods of calculating capital gains tax, which is generally worse off for property investors. If you look at the history of in property investing and prices of properties across the country, and they'll be worse off, and that means that there is a lot of uproar, for one, and to lock in your CGT valuation, just like when you live in it and rent it out, from when it's 50% to the inflationary base indexation method, post 30 June 2027, there'll be a new method of calculating your cost base that will require a capital gains tax valuation on the 1st of July 2027. So really important date. And of course, if you can try to lock in a value that is most favorable to you, it's going to be very helpful. And if you can argue with your valuer or your accountant as to what your value is worth on that date, when it comes time to sell, if you do sell, and the average turnaround time for selling a property is 9 years, PJ, in this country, meaning that from 2027 to 2036, in that period, people are going to sell their properties. They're going to want to get as high a value on their property to make sure that they can try to optimize their tax situation on the CGT, because capital gains tax is going to be tricky in terms of calculation. It's going to be quite messy, and so I think that's one of the biggest uproars. And of course, the most damaging part is it applies to all asset classes and not just property, which is kind of contradicting what they're intending to do, and that is to help the housing supply situation. But it's curbing, business investment as shares and stocks and crypto and all asset classes are affected, and that's, I think, the biggest bummer for Australians.
I mean, I suppose at least on the share, you'll be able to, grab the closing price on, June 30. So that'll be pretty easy to do. Much harder with a property. So, and we earlier just before the podcast, we toured the office, and you were explaining that you're anticipating that this is going to be a thing, and that people are going to probably get this advice, with little time left. It's not that they'll be out of time. They could do the valuation in 5 years' time, and you would just do a retrospective one. But it's probably better to get it done sometime around that period, so that you really do get the actual correct value at the time. So you're gearing up for that. You're anticipating that you're going to have a lot of interest and phone calls from people getting valuations or wanting valuations.
It seems to be the general consensus now that people want to lock in. I think the damning part is when they bought the property, they were promised that the discounts were in place, but to see that it's not going to be protected after the said date, 30 June 2027, means that it's creating a lot of uproar. And of course, we're here to support them through that, and we'll work with them to try to optimize their tax situation as we can do best.
I'm also now wondering whether or not we're going to see a flood of properties for sale in the last 6 months of the financial year 2027. That'll be an interesting observation to make.
And I guess the whole idea behind not mandating the CGT on the 12th of May 2026, the budget night, is to give that leeway to not create a lot of chaos in the economy, because the last thing they want is to have a flood of sales, but they'd rather see the flood of sales happen over a period of time to ease the tension. But we'll see. I think it's only been a month now, part of it, and there has been a lot of changes already. So a lot to come in the next 11 months.
Yes, indeed. I think it is going to be interesting to watch. Okay, well, that was a biggie. Is there anything else on your mind that you want to get out there?
Not that I can think of. I think it's exciting as much as it is anxious. Creates a lot of angst in the economy. But I think, there's one thing I think is certain, is that the wealth has been created by that generation and the generation of the people that have been able to access. Whether it's going to alleviate, I think, is yet to be seen. And really increase housing supply for the next generation and reduce this inequality of wealth, as they say. That's something to be seen. What are your thoughts, PJ?
My thought on a lot of things that the government does is it's better to wait and see whether it actually gets up, because as we established earlier, it's not yet legislated and it's not been passed into law. I'm sure that there's been a lot of phone calls to local members of parliament and senators and so forth from all facets of Australian life, probably expressing some discontent around not just this sort of policy, but even the trust stuff. I think, unfortunately, there's a lot of class warfare that has come into the political sphere, pitting the rich versus the poor and all this kind of thing. And I don't think that it's about that. I think that owning property in Australia has been a dream of many Australians for a long time, whether that be their principal place of residence or an investment property. And now the government, the Labor government, is messing around with that. And I think even their typical constituency, would probably be sitting back thinking, well, hang on, is this really going to be beneficial for me long term? Is it going to improve my trajectory to growing my wealth? I have my doubts. I think there's a lot of unintended consequences. We've talked about a few of those on this podcast that will not be borne out potentially for 3 to 5 to maybe even 10 years. And you know what? The current government will be long gone by then, and the people in it will be retired and, enjoying a nice pension. They won't care. But these are the things I think as Australians, even though I don't sound like an Australian, I am an Aussie, that we should be, asking our representatives to be thinking about and debating when they talk about, passing these laws. So I hope that's happening. And I would encourage people to do that. Get involved in the conversation. Find out more about this stuff. Platforms like this enable me to, interview people like you who are very much in the know, been operating in this space for a long time, and can add to that conversation. So I really appreciate the time we've spent together today.
No, thank you, PJ, as always, and thank you for your support.
No worries. Thank you for joining me on the Money Matters podcast. Like and subscribe for more podcasts, and we'll see you on the next one.